best time then to get in a big market voice. And who other than Akash Prakash of Amansa Capital, who spoke with my colleague Nikunj earlier on in his first interaction after the budget. Akash, of course, is an avid India watcher and India investor, shared his assessment of the budget fine print and the much talked about LTCG issue. He covered all angles that can impact sentiment with regards to this long-term capital gains tax being brought back. Hear him out.
I think it's basically steady as she goes. I mean, it was a pretty workmanlike budget, nothing very radical. The fiscal math is credible. It is an election year budget in terms of the rhetoric and the statements and the orientation and the amount of time he spent talking about rural India and other things. But nothing which I think will, topple the apple cart, but nothing which will cause me to get more bullish or anything of that type. Right? Basically, I think it's something the market will shrug off and ignore after a couple of days. Yeah.
Are you delighted and also surprised that markets have shrugged off the LTCG news? LTCG and STT, they both coexist, and there was no nervousness in the markets yesterday?
Yeah, I think the market's reaction indicates it was pretty much discounted. I think the Indian media for the last 1 month has been speculating pretty strongly that this will come. And the Prime Minister and the Finance Minister in multiple forums have also talked about it. So I think the market's reaction indicated it was fully discounted, more or less. Second is, I think they've softened the blow by letting you reset your cost base to 31st Jan, which is effectively 36,000 or whatever on the, or 11,000 on the Nifty. So yeah, I think it indicates that it was discounted. And frankly, in this environment, given the scarcity of resources, I'm not surprised they brought in long-term capital gains, and given the political messaging around that, I'm not surprised it's come.
But a 10% tax, do you think it could have an impact on inflows because suddenly Indian equities are not tax-free? Could that have an impact on the investor psychology?
I don't think it'll have a significant impact in the sense that obviously your expected return profile for India drops by. So if you thought you will make 14-15% in India, which is what the long-term rates of return in India have been in rupees, obviously you will lose 10% of that, 1.5 to percent. Let's say 15 becomes 13.5. So it will obviously impact the attractiveness of India on the margin. But right now, short term, I don't see anything. I don't think this is going to dramatically change people's perception of India or inflows. What it does, of course, also mean is that the paperwork around investing in India increases tremendously, because all funds, including us, will now have to start accruing for long-term capital gains. The auditors will have a field day saying, how much do you accrue, what do you accrue, stuff like that. So the paperwork, it becomes more cumbersome to invest in India. The paperwork goes up. I think that is the more of a pain point, frankly, short term, than the expected return decline, because for the bulk of our portfolio, everything in our portfolio today, the cost has been set up for 31st March or for 31st Jan. So you're not going to have significant, short-term basis, significant capital gains because your cost base is set to 31st Jan. But the paperwork goes up immediately. So I would worry about the short-term paperwork being a disincentive more than the return. Longer term, obviously, you have a 10% reduction in your expected return profile. I said 15 goes to 13.5. Unfortunate, but it's not a deal breaker from my point of view.
But Akash, if future returns are going to be going down and they would go down by about 10%, could that have an impact on the aggregate paper demand and the P multiples?
I don't think it affects the P multiple. Right now, I think, Nikunj, as I said, longer term, this will have an impact. And if we take a 5-year view, there will be some impact because, as I said, as allocators sit there and look at expected return profiles of various markets. India, over the last 20 years, has delivered, somewhere between 14-15% in rupees. So obviously, if you now put in a 10% long-term capital gains tax, that 15 drops to 13.5. So obviously, people will weigh that 13.5 vis-a-vis the expected return profile of other markets, and depending where India stacks up, they will move money. I don't think this is enough of a decline to dramatically change allocations. It will, on the margin, hurt a little bit, but it's not something which will fundamentally, dramatically change allocations, because remember, you have to make money to make a capital gain, right? So the reality is capital gains tax only comes if you make a capital gain. So the reality is you're coming to make money. So it will have some impact, but this is not going to significantly change flows in my view. In the short term, for sure. Even the long term, I don't think it significantly changes flows. Short term, I am saying this again, the shorter term pain is going to be the paperwork and the having to file a return with the income tax people, getting your auditors to start accruing long-term capital gains. All that is a big pain point. So you could see people saying that I don't want to deal in India directly because I have to, get a PAN, I have to file return, I have to do ABC. I'll go to Singapore and, because Singapore SGX has launched these single stock futures and all that stuff, which has no tax at all. So unfortunately, we run the risk of some movement of our market and liquidity to Singapore, which I think will be unfortunate if it happens. But that is some risk. But I don't think this is something which is going to dramatically change flows, in my opinion.
Budget aside, what do you make of the current price action? 2018 has been off to a dream start. 2017 again turned out to be a year of dreams. Is it only cheap liquidity which is driving markets higher? Is it like a rising tide and all ships are going higher?
Yeah, I think to a certain extent it is, because you look at globally, right? I mean, the US is off to a dream start. All global markets are off to a dream start. Flows into emerging markets are significant. So India is getting its share of foreign flows as well, because just as a derivative of money coming into emerging markets. Domestic flows remain quite robust. I think the changing nature of the market, if you see, the big caps have significantly outperformed mid caps right now, because on the margin the foreigners have turned from sellers to buyers. So the nature of the buyer on the margin has changed and to the foreigner, which means large caps and more liquid stocks. So there is some sector rotation, like IT and the larger caps and stuff like that. But yeah, so I think right now it is global liquidity, frankly. I mean, you've gone from a period of time in India last 6 months where the domestic investor was the only game in town. They were buying continuously. The foreigners were some months selling, some months buying, more or less a wash. In the beginning of the year, first month, both foreigners and locals have been buying. And the foreigners have been buying more aggressively, which is why the nature of the market has changed towards larger caps. I think the mid caps have gone through a nice correction. There's been a lot of distribution there. The market has cooled off. A lot of the stuff you're seeing, crazy stuff happening in small cap, mid caps has kind of got ironed out. There has been a significant correction there, which I think also is healthy. So I think strong global liquidity is driving the markets right now. A good healthy correction we're in the middle of right now in the mid caps and small caps. So I think that's fine. I'm a bull on corporate earnings. I think you're going to see strong earnings growth over the next 12 to 18, next 2 to 3 years. I think already last quarter earnings were slightly better than expected. This quarter earnings are better than expected. I think you will see we are in a cycle. We're starting a cycle of earnings upgrades. If that's right, then this market has more legs to go. The only caveat to that is if oil goes to $100, because oil at $100 significantly impacts the macro for India in the sense of inflation, liquidity, interest rates, stuff like that, which could impact PE multiples. The bull thesis is what? The bull thesis is multiples hold, and you get 20% plus earnings growth for the next 3 years, and that is what will drive the market. For stable multiples, strong earnings growth. The counter to that is earnings will not come. I don't believe that, but there is a view there that earnings haven't come for the last 5 years. Why will they come? And the other counter to that is multiples will decline because you're going to have a spike in interest rates. You've already had 100 basis points hike plus rise in the 10-year bond yield. If oil keeps rising, that could go further. If the RBI doesn't loosen liquidity, it could go further. So the counter argument is earnings will not come and interest rates will continue spiking because of tight liquidity and hiking inflation and high oil prices. I'm still in the first camp, which is that multiples will remain stable and earnings will come, and therefore I think the market still has legs. You may go through 3-6 months of market catching a breath, consolidating, but I think we're still in the middle of this bull market. We're not at the end, because I genuinely believe that the stuff they've done on GST, the stuff they've done on the insolvency and bankruptcy code, you will see a significant surge in corporate earnings for the listed large companies, which is where we invest, or the listed sector. So I remain in the bullish camp, but we must accept that there is a bearish narrative out there, which is not illogical, which is that earnings will not come because they haven't come for the last 5 years, and you will see a PE multiple compression because of spiking in interest rates and weakening macro. So you're going to see which side of the narrative you believe. I believe the first narrative, but I respect the views of the second narrative, and I'm constantly evaluating and assessing that could the second narrative come into play.
Akash, historically the way you've invested is that you've always looked at businesses, companies or sectors which are at an inflection point. It could be a market share gain, it could be an earning inflection point as well, and then you take large bets in mid-tier companies. So where are you picking your spots? Where do you think companies or sectors which are on an inflection point for demand and for earnings?
I think it's eclectic, Nikunj, in the sense that, and I'm not trying to duck the question, but it's really eclectic in the sense that, we've recently been buying stuff in, we bought something in media, we bought something in insurance, we bought NBFC, we bought a chemical company. So it's really eclectic. We're looking for stock-specific stories. So inflection point doesn't necessarily have to be the industry. It could be in the company. It could be change in management. It could be M&A. It could be something that China, like in the case of chemicals, China has significantly taken capacity offline on specialty chemicals. Prices have gone up. China's sanctity as a reliable supplier, that sanctity is being questioned. So it doesn't have to be necessarily a macro industry evolution. It could be like in the case of industry consolidation in one sector we're looking at because of industry consolidation. But largely these are stock-specific stories, change in management, new product launch, gain market share, etc. So we tend to be very bottom-up, very stock-specific. As I said, we don't do more than 3-4 new decisions in a year. So I think we have enough of that type of stuff happening in India that we feel no lack of opportunities at the moment. The large private banks is really a very consensus trade, and the Kotaks and HDFC banks and Yes and all these things. I mean, they're great banks, outstanding management, great track record. I think that is a very consensus crowded trade. Having said that, I think they will benefit now because there will be rotation away from NBFCs. I think the NBFCs will get challenged because of the spike in short-term interest rates. It does hurt NBFCs more because they are wholesale funded institutions. So it obviously hurts them more than it hurts the banks. Banks actually in the short term will gain from the rise in interest rates, the steepening of the, not steepening, but the fact that pricing power will come to the banks. The value of the CASA franchises will go up in a rising interest rate environment. As credit demand starts picking up, which we think it will in the coming year, there will be some increased pricing power to the large corporate banks especially. So I think right now we were at a time very optimistic on NBFCs and less positive on the banks because they were very crowded. I think that trade is reversing again tactically, where because of the tightening liquidity and the spike in short-term interest rates, I think NBFCs have a bigger challenge. The banks will do better than the NBFCs. Also, I think we have been very bullish on the insurance sector. I think we mentioned this to you last time as well, that we think that the type of growth and profitability and market cap creation that you saw in the private banks over the last 10 years is something you will see in insurance over the coming 10 years.
Akash Prakash sharing with us his sense of the budget fine prints and what he made of the long-term capital gains tax impact.